Hey, Paul here, and in this video we're going to talk about that often overlooked but yet still important decision of who should be the owner of your life insurance policy. So few people actually make a conscious decision regarding who the owner of their life insurance is when they purchase a life insurance policy, but that ownership of a life insurance policy can have some significant effects down the road. So let me give an example. Let's say Larry and Linda are married. They have 2 kids, kind of a typical traditional, married couple. And at some point during Larry and Linda's lifetime, they decide to purchase life insurance. And they each get $1 million of life insurance. Now, what I'm about to tell you applies whether it's $100,000 of life insurance or whether it's $4 million of life insurance, but let's use a nice round number, $1 million. Each of them gets life insurance for $1 million. And so the question becomes, who should own each of their policies? And I'm going to disregard estate tax for a moment, but I'm going to come back to it towards the end of the video. So typically what happens is each spouse owns the policy where they are the insured. So Larry is the owner of the policy where he is the insured. Linda is the owner of the policy where she is the insured. Let's go back to Larry's policy. He's the owner, he's the insured. He likely names his wife Linda as the primary beneficiary, and then likely names his, let's say, their 2 children as the contingent beneficiaries. And that all works well when Larry dies. Linda applies for that death benefit. She's the primary beneficiary of the policy that Larry was the insured and Larry was the owner. So she applies to the life insurance company for that benefit. They write her a check for $1 million. Now she has the $1 million life insurance on Larry's life, and now she is still the owner of the $1 million life insurance policy on her life. So as the owner, she has all those rights that owners of life insurance policies have. She can, if she wants to, change the beneficiary. She can access the cash value. She can cancel the policy. She has all those rights. She's the owner of the policy of which she is the insured. She probably won't access the cash value because she just got $1 million from Larry's death, but she has the right to. But sometimes it's set up where it's not that easy. And quite frankly, it happens a lot. And for some reason, I don't know why, but I know it's because there's some people out there who sell insurance who thought it was the right thing to do for couples to have this kind of cross ownership of life insurance, where the husband owns the policy where the wife is the insured, and the wife owns the policy where the husband is insured. And same beneficiaries. So on that policy where the husband is the insured and the wife is the owner, wife Linda is still the primary beneficiary, kids are contingent beneficiaries, but it creates some problems after the first spouse dies. So let's say Larry dies, he's the insured on a policy that Linda owns. No problems there. The life insurance company will pay Linda the $1 million. But the problem now is that dead Larry owns the policy on Linda's life. And now that if Linda wants to exercise any of those rights of ownership that owners of life insurance policies have, Linda can't. She can't, she can't access the cash value. She can't change the beneficiary. She can't, modify or terms or do anything that a owner of a life insurance policy could do. So that policy now on Linda's life, which dead Larry is the owner of, the ownership of that policy has to go through probate, and the ownership of that policy that is in dead Larry's name will be transferred after the probate proceeding completes to dead Larry's heirs. Maybe that's Linda, maybe it's others. So that's who would wind up owning the policy on Linda's life of which dead Larry was the owner. So It creates a lot of probate problems. It creates a lot of ownership problems. And so just a couple of observations that come from that. You know, many people in America, they structure their estate to avoid the court and attorney involved probate proceeding when they die. And the way the conversation with the attorney kind of goes, and they're all checking the boxes. Do you have a home? Yes. Okay, we'll put that in your trust because that would have to go through probate. Do you own some investments? Yes, let's put that in your trust. That'll avoid probate. Do you own a business? Yes, let's put the shares of the membership interest in the trust. That'll avoid probate. Do you own an IRA? Yes, we don't have to worry about that. That has beneficiaries. Do you have an annuity? Yes, don't have to worry about that. That avoids probate. That has beneficiaries. Do you have any life insurance? Yes, don't have to worry about that. That has beneficiaries. But you know what? Should have held on. Should have explored further on that life insurance to find out who not only the insured is and who the beneficiaries are, but also who the owner is. Because for reasons that I explained earlier, sometimes the ownership of a life insurance policy has to go through all the probate stuff, and it's just an inconvenience, particularly when you've got everything else structured to avoid the probate and you've got to go through a court proceeding just to get the ownership of a life insurance policy transferred out of a deceased person's name. So I really see no good reason for this cross ownership of life insurance. There is no estate tax benefit. Let me kind of give you that example. So in the normal scenario where Larry is the owner and the insured of his life insurance policy, $1 million, and he names his wife Linda as the primary beneficiary. When Larry dies, because he did own the policy, that $1 million is part of his gross estate. But since he left or named Linda as the beneficiary of his life insurance, that $1 million, while it was included in Larry's gross estate, gets deducted from Larry's gross estate pursuant to this marital deduction, which says anything you leave to your spouse gets deducted from the gross estate before the net estate is calculated. So it's as if that $1 million life insurance policy that Larry owned and Larry was the insured is not in Larry's estate. So there is no estate tax benefit to this cross ownership of life insurance policy between husbands and wives, but it can cause a probate problem. Then if estate tax is a concern, then what many parents do is to keep all of that out of the estate, because in the previous example, now that Linda's the surviving spouse and she has $1 million policy herself, and when she dies, she doesn't have a spouse to leave that to take advantage of the marital deduction. She leaves it to the kids, and so that is part of her net estate for estate tax purposes. Now, if parents or couples want to avoid that scenario, then from the get-go, they either name their children or a trust for them as both the owner and the beneficiary of their life insurance to keep all those death proceeds out of the estate of the parent or parents. So that's a separate issue. But just the cross ownership, husband owns the policy on wife's life, wife owns the policy on husband's life. Really, I just don't see any benefit there. I guess maybe somebody spread the word many years ago that created some estate tax benefit, which it really doesn't. So be careful on that. You may want to go back and revisit the ownership of your life insurance policies to make sure you get all of that straight. And then right before you check the ownership, make sure you smash the like button. That way YouTube will share my videos with more people. And if you haven't already, click the subscribe button and the notification bell so you don't miss anything. We'll see you next time.